Welcome back. Here's a look at how the Canadian dollar is faring today. It is at 70.47 cents US. And as you can see, it's rallied through the month of February, mainly because the US dollar has been under pressure over that period of time. Let's get the views of a veteran strategist and a frequent guest on this channel. Colin Cieszynski is Chief Market Strategist at SIA Wealth Management. He joins us now from Toronto. Colin, great to see you. Thanks for joining us. What is the biggest influence right now on the Canadian dollar? Typically, it is the currency market's view of the Bank of Canada versus the U.S. Fed. Is that now being superseded to some degree by the tariff situation?
I think it is, Paul, and something that we've seen that was quite interesting was following the U.S. election, as soon as the tariff rhetoric really started to ramp up, we saw the Canadian dollar underperform the U.S. dollar quite dramatically, along with a number of other currencies. But what's been interesting is that in the last month or so, it's almost been almost a sell on rumor, buy on news kind of situation, the reverse where we saw it under pressure for so long. But now that we're kind of into this, the dollar's actually stabilized. And as you mentioned, it's back above 70 cents. And dollar CAD's been coming down. So that's generally a positive thing. There's still room for volatility out there because this isn't resolved yet. We don't know how this is going to end or if tariffs are going to be implemented and when and how much. And or if things might get delayed again. But so far, this 1 month delay in the introduction of tariffs has helped the Canadian dollar. It's also helped the Mexican peso as well to bounce back a little bit. And but as you mentioned, there's still questions about where is the U.S. dollar heading from here. We saw one of the reasons it strengthened was Treasury yields had gone up, but they've now leveled off, and the U.S. dollar seems to be leveling off against pretty much everything else as well.
The Bank of Canada, of course, is now well along its path of cutting rates to stimulate the Canadian economy, try and boost growth in the Canadian economy, which is much, much weaker than in the United States. Does a weak loonie, it's risen recently, but it's still historically weak. Does that make the job of the Bank of Canada that much more difficult?
In some ways, it's more difficult, and in some ways, it's easier because a falling Canadian dollar actually helps the Canadian economy. It helps to offset some of the challenges that we're facing, particularly relative to tariffs. So a decline in the dollar in some ways can be have a similar impact to an interest rate cut. The one thing we'd have to watch for is if we had the dollar get really distressed, and we saw this about 20 years ago, there was a situation where the dollar was down so much that the Bank of Canada actually had to step in and start raising interest rates to defend the currency. We haven't gotten to that point yet. And even at the lowest point we've seen over the last couple of months, we're not at that point yet. But it is something that if it were to worsen dramatically, it could be an issue. But for the moment, it's they do seem to be working hand in hand to help support the Canadian economy, the lower dollar as well as falling interest rates.
Retail sales numbers in Canada are due tomorrow. These will be numbers for the month of December. What do you expect those numbers to show us, Colin, in terms of the strength of the Canadian consumer, the willingness or ability of Canadian consumers to spend?
Well, the expectations for retail sales are actually pretty strong, which is interesting. That could be due to a combination of factors. It's December is still the holiday season. Plus, there was the introduction of the savings and the GST as well. So there could be some distortions in there. So it's hard to say exactly where the retail sales might land, but it's still a significant indicator, and it's something to note that. That retail sales numbers are coming in just as we're starting to move into retailer earnings. So we saw today Walmart, which is a company that we hold in some of our portfolios, had a pretty decent report. They beat on sales and earnings. They raised their dividend, which on the surface sounds great, except their guidance was lower than the street expected. And the big thing for retailers going forward, particularly in the United States, is what happened in January. We had the deep freeze that impacted the U.S. even more than Canada. We're used to winter up here. But you also have the wildfires in California, and so you're starting to see potentially more distortions work in. So that's another thing with Canada is we're looking at December, but then there were all these distortions in January. So it's going to be a bit hard to get a read on it. But certainly, if we get a good number, that would be great.
We spoke with an analyst on Walmart during this program about half an hour ago. She believes that stock deserves its substantial premium valuation. It trades at more than 35 times expected earnings. Do you agree? You do hold it in some of your client portfolios?
Well, as you know, Paul, we measure on based on relative strength and performance of stocks relative to other stocks in the universe. And Walmart is almost right at the top of the U.S. rankings and our U.S. reports. So it's been very, very strong on a relative strength basis. That may come off a little bit with today's sell-off, but not huge. It's still this was almost right at the top of the rankings. The other sectors that are right up there with Walmart were things like Netflix and Meta on the communications side. So it's been a very strong stock. It's been very strong relative to the S&P 100 at this point in time.
Why don't we finish with gold? As you know, gold is very, very close to record high levels, and there's all kinds of positive sentiment around gold, including informed sentiment, including from people who have followed the gold market, as you have for many, many years. What is your take on gold? Are we going to see $3,000 gold before too long?
It's definitely still a possibility. I've always been one of the mind that prices tend to get drawn to big numbers over time. So 2,500 was a big number for gold, and it kind of hung around there for a while. And then once it lifted off, well, then it took a run at 2,750 and hung around there for a while. And now 3,000 would seem to be the next one. And what's more important here is we are seeing a little bit of caution out there in the markets. Although it's a funny thing is we see the S&P 500 hitting new all-time highs, but the upward momentum for U.S. indices has kind of slowed. It had a big lift at the end of the year, and yes, we're eking out new highs, but not as much. And then today we're seeing some profit taking in the market, whereas we've seen gold pick up, we've seen silver pick up, and interestingly, we've seen the yen pick up. So the traditional defensive havens have quietly been strengthening, and that means capital has been slowly but surely moving into those areas.
Colin, thank you as always for joining us. Colin Cieszynski is Chief Market Strategist at SIA Wealth Management. Coming up.